Today I'm going to talk about a paper with Ian Dew-Becker and Pooya Molavi. Ian is also here, and so he may answer some of the questions. And the disclaimer on the board on the screen is because Ian is at the Fed, and so this we don't represent the views of the Fed here. Okay, so what do we talk about today? Today the work is on trying to understand nonlinearities in financial markets. And we're going to show that many of these nonlinearities that are well known and well documented in financial markets, in asset prices, they can be linked to learning by investors, very general. And that's kind of the point of the paper. So to give you a bit of an introduction, let me just 1 second hide this. Okay. So it's well known that the stock market is a great laboratory to study the dynamics of beliefs of investors for two main reasons. One is that we have great data. Okay, we can observe prices, we can observe volatility, we can observe a lot of even higher moments like skewness at very high frequency. So we can really focus on the dynamics both at the long end and the short end with great data. But also because learning and filtering information that continuously comes out about the value of the security is really one of the key functions of financial markets. And so, of course, you all know these features of financial markets have been used widely to study beliefs. And so we're also going to study the beliefs in this paper. What we'll do that is novel in this paper is going to study them through a very general model of information acquisitions. So the point of the main goal of the paper is the following. We're going to take a bunch of patterns, nonlinearities that we have been documented in financial markets. We're going to argue that we can explain them not just qualitatively, but also quantitatively through a very, very general learning model. Okay? And that's what we do in the paper. So let me start by telling you a little bit about what are the main patterns that we're going to aim to match. The first one is, and the most interesting one, is what's called the leverage effect. And it's simply saying that when prices fall, volatility goes up. Okay. Now, the focus of the paper will be exclusively on the aggregate market. Okay. And so every time I talk about prices, I'm going to mean something like the S&P 500 prices. Okay. And so, for example, when you look at the movements of volatility of the S&P 500 and prices, there's an incredibly high negative correlation between the movements in volatility and the returns. Okay, so there's a 70% daily correlation and 80% at 15-minute level between the returns in the S&P 500 and changes in volatility. Okay, this has been called the leverage effect. We're going to talk about later why it's been called like that and how to interpret it. But it's just an incredibly strong empirical pattern. And why is it particularly interesting? Because one of the most important features for investors when they think about the market is this kind of left tail, right? Is the fact that you might invest money and very quickly you might lose a lot of money. Well, there are two kind of main conceptual mechanisms that could drive that, right? One is there are just random jumps that happen, in an unpredictable way. But there are also the possibilities that some of this left tail is due to the leverage effect, which is, prices fall a bit, volatility increases, the next downward movement is bigger, and then the downward movement increases volatility. So the leverage effect, the left tail returns could very well be driven by, and we're going to argue that is in large part driven by the leverage effect, but the fact that volatility is getting high after a drop. Okay, so we think it's important precisely because, or partly because, it's responsible for many of these left tail events. There's other patterns we try to match. One is this interesting pattern of long memory in volatility, which is that if you think about shocks to volatility, they don't seem to decay exponentially. They decay fast at first and then they kind of slow down. So it actually takes quite a while for volatility to mean revert. And then we're going to try to generally match joint moments of returns, volatility, and skewness. Okay, so there's a lot of interesting dynamics that we can try to explain in the data. Let me give you some pictures about these facts. So this is in one particular day, the movement of the S&P 500 in purple and blue, and then the VIX in red. And you can see that they are really very strongly negatively correlated. Okay, there are basically almost every blip that you see in one line has another similar blip on the opposite side on the other line. Not just the big movements, but also small movements. There's just a very, very high negative correlation. This is if you take the last 30 years of data. and you look at daily, every dot here is a daily change, a market return during the day, and the daily change in volatility, you can see this very, very strong negative correlation throughout. This kind of unconditional relation. And what's really even more striking is that this negative relation holds even within every month. So these are, each on the right side, you can see a data point for every month since the early 90s or the late 80s, which is when we start having volatility, impact volatility from options. And what this is the slope of a regression of the changes in volatility on the market return done separately month by month. So there's 20 observations per month, so there's some noise in estimation error. But you can see that the point estimate in every month except two over the last 30 years is negative. So, which is interesting because it tells you that this leverage effect is there in good times, is there in normal times, and is there even in bad times. Even at the bottom of the crashes, you still find a leverage effect. Okay, we're gonna come back to interpreting this later. And to give you a little more background on the leverage effect, the original name from the leverage effect came from the idea that essentially, of course, there's just literally a mechanical leverage effect, which is a levered firm that has some bad shock is going to have essentially more leverage, and therefore this will amplify future shocks. But it has been shown that that's not what's going on in these markets. The leverage effect you find, for example, also in firms with our all equity. So clearly, it's not just mechanically due to leverage effect, but for convention, I'm going to keep calling this the leverage effect. Okay. There's another channel which is the essential risk premium channel, which says that what could be happening in the genesis negative relation is that you get bad news and this you get volatility news, so volatility goes up and the risk premium go up, and through a discount rate effect prices go down today, right? So the causal link will be from volatility to discount rates to prices. Okay. But of course the key, and that could be driving part of this, but of course part of the issue here is that we also know that there's not a very strong relation between volatility and risk premium, right? There's a very strong it's one of these kind of puzzles that we have not really ever solved. And so it's probably not this either. And then there's a third explanation, which is what we base our story today, our paper, which is about learning. Okay. And so you can see there's a long list here, there's many more. There's been many, many papers that wrote down specific models of learning, right? Where, for example, I'm going to use the Veronese case as one of the examples where there's an agent, doesn't observe the true state of the economy, seeing some information, tries to learn about that, and therefore prices adjust. Many of these, basically all of these papers write very specific learning models, and they say, well, in this particular model, I can generate through learning, I can generate some of these patterns. Okay, and typically this model can generate some facts, but not of others of the various patterns I showed you before. And so what we're going to try to do in these papers, we're going to try to build on the learning literature, and we're going to show that we can actually solve a very general learning model. And we're going to argue that the learning itself can generate all of these patterns simultaneously. Okay, so we're going to generalize greatly these explanations. Okay, a couple more patterns I want to show you which are interesting. On the left-hand side here, we have the skewness of holding period returns as you change the holding period from 1 day to 250 days. Okay, so the question is the following. I might have a trading strategy where I hold only returns one period for every day. I can think of the skewness of 1 day returns, or I can think of the returns, the skewness of a 1 year horizon holding period, right? And the skewness of these different horizons, of returns over different horizons, depends on the fundamental, on the structure of prices. Okay, and we could see in the data is that the 1 day returns are left skewed, but not so left skewed, right? And then as you increase the horizon, they become more and more left skewed, and then in the long run, they're really much more left skewed. Okay, these are log returns. And so we're going to ask ourselves, can learning generate also this pattern of skewness across horizons? Okay, and finally, we're going to look at long memory, as I mentioned before. Now, what is long memory? You can think of it as simply that shocks to volatility don't decay exponentially. Now, to visualize that, what we do is we compute autocorrelations of volatility, and we're going to take one of that, so the inverse of the autocorrelation, right? So that means that essentially exponential would be, you should see an exponential function here. you can see from the data is linear, and that's something has been kind of discussed in econometrics for a very long time. Okay, so these are the patterns we're gonna aim to match. How do we match that? What is our model based on? So the starting point, the key point of the paper is really a general filtering result that we derive. Okay, and it's gonna be the following. There's a general filtering model in which investors have completely arbitrary beliefs about some fundamentals. Okay, so the idea is there is a fundamental value of the stock market that people are trying to learn about, and they see information, and because they don't know what it is, they're carrying around a distribution. And every time they see some news, some information, they update the distribution. And the key of the paper is that we actually are not tied to a specific model of a DGP of the underlying fundamental value. We're going to leave it completely unrestricted. We're just going to say there is some process. People are trying to learn about the world and they don't know what the fundamental value is, and they're carrying around this completely arbitrary distribution. Our result is going to describe how this entire distribution updates and how it changes with new information. So essentially, it's a way to think about the application of Bayes' theorem in a context where you're learning about fundamental value of the stock market. And the point is that we can derive the following result. There is a recursive description of how this distribution of beliefs is changing over time. In particular, we show that when you get a piece of news about the fundamental value, of course, what's going to happen is you're going to update all the moments, right? The entire distribution potentially changes. But it changes in a particular way. It's going to be that the way you update your mean of the distribution is going to be proportional to your variance of your beliefs. And the way you update your variance turns out to be proportional to the third moment. And the way you update the third moment is proportional to the fourth moment, and so on. In fact, this goes on forever. Okay? And so by doing this, by kind of recursively characterizing each moment, we can characterize the dynamics of the entire distribution over time. And that's the key theoretical results that we then apply to the data.
Let me jump in with
Yeah.
a question. We have a question about some of the preliminaries. So the question is, the leverage effect is asymmetric. It's much stronger for negative market returns. Will the model also be able to explain this?
Yes. The answer is yes. Yes, you'll see exactly. I'm going to show you exactly how that looks like. But yes, the big, it's here. It's going to be clear if I just show you the model. You'll see that. Yes.
Okay, thank you.
Can I go on? Oh, there's more questions. All right. So let me tell you then what we do. So we derive this theoretical result, and then we do a few things. Okay. So first is we're going to use it to establish some necessary and sufficient conditions that must be happening in a learning model to generate those facts. Okay. So for example, I'm going to argue that the skewness of the fundamental, the skewness of this distribution plays a fundamental role, is actually what drives the leverage effect. It's a very general result. Then I'm going to show you a very simple calibrated model that even though it's really, really simple, it can actually match quantitatively all those patterns and is built exactly based on the insights from the general learning model. And then finally, I'm going to show you that we can test some of these restrictions about this relation between how all the different moments evolve using data on prices, the VIX, and other option implied moments. Okay, so the bottom line of the paper is that a very simple filtering framework where the key is that the prior distribution is not normal, so it's kind of much more general, is what you need to explain many of these empirical patterns. Okay, so I finally can go to the, it was a bit of a long introduction, but let me go to the actual result. So these first few slides, I'm gonna just essentially state this theorem that allows us to characterize the evolution of beliefs. Okay, so just in terms of notation, we're gonna have an information set, okay? And this is the information set is an arbitrary information set, okay? And we're gonna say that the price for an investor with that information set is simply the expectation given that information set or the fundamental value of dividends, right? The present value of dividend discounted as some STF, okay? Now, for the presentation today, I'm gonna treat M as a complete exogenous, okay? In particular, exogenous to the information shocks. We have an extension in the paper, we deal with some of the cases where M is endogenous to information. But for now, we just say, look, I have an STF, and I'm trying to my best to figure out what's the correct present value of the stock market, which is how much I should be paying for the stock market. That's the price, right? The price is going to be set at the expectation of this object. Okay. Now you can think of, of course, I don't have full information. If I had full information, I would observe theta t, which is a kind of broader, a finer information set. Okay, and the I think of the fundamental value as simply being what I would pay if I knew all the relevant information, right? The price with this information set theta t. Now, most of this this notation is really there for making sure that the results are kosher with all the mathematically speaking. But generally speaking, you can just think of it as there's a fundamental value xt. This fundamental value of xt is a scalar, but it's driven by the dynamics of the world, which is captured by theta t, which could be a very complex vector with very complex dynamics. And xt is just gonna be linked by the pricing function, and it's gonna move around with the arbitrary dynamics. Okay, so this is the bottom line of this slide is simply that there is a fundamental value. People are trying to learn to form expectation about the fundamental value xt, but they don't observe it. So they have they have the entire distribution about their beliefs about xt, right? The price will be the mean of this distribution, in my best guess, given what I know. And the entire distribution of beliefs about xt is going to move over time. And we're going to put no restriction whatsoever about xt. Okay, so xt could be, non-stationary. It could have, stochastic volatility. It could have, heavy tails. It could be a giant diffusion. It could be anything. Okay. So people are going to be learning about something which is a very arbitrary distribution. That's what buys us generality. Okay, rather than specifying, well, this is the DGP that drives around X, we're going to just say we're going to leave X, the people are trying to learn about, completely unspecified. However, what we're going to put restriction is what is the information people observe. Okay, so people will observe one noisy signal about XT. So our model of the world is like we are all trying to learn what's the fundamental value of the S&P. And then every day we see a bunch of signals, we combine them into what's our best guess of XT is given today's new information. Okay, so we get this noisy signal about XT, and the key is that, as you will see in the next slide, this signal Y is assumed to be normal. So the only very strong restriction we put into the learning process is that we're going to assume normality of the signal. So the signal will be distributed normally around XT. Now, there's one more approximation that we need, which is that because we're looking at a price which are geometric process, we're going to assume that people are learning about the log fundamental value directly. So we're going to exchange basically the log and the expectations. But we have an extension that also deals with this. And in the numerical examples, we do this without approximation. Okay, but for the rest of today, in the theory part, we're going to assume that I'm trying to learn about the log fundamental. Okay, so that's the information set. So I have this kind of xt I'm trying to learn about, and I see a dy, which is a signal, which is some sigma yt, which is it drives the precision of the noise component of the signal, and this is a Brownian motion. Okay, so this is the core restriction of the paper. The entirety of the results of the paper are driven by this one restriction. Okay, whereas there's no restriction of what's happened with xt. Okay, so that's the model. Okay, there's xt. Prices are going to be formed as there's going to be a belief distribution of xt. Prices are going to be the first moment. And so therefore, importantly, think about the following, right? The dynamics of prices are then going to be driven by how this entire distribution is moving around, right? So the volatility of prices is going to be driven by the volatility of this first moment of the distribution. Okay? And then we have a signal which is normal. So what can we say about the evolution dynamics of prices in this two-equation model? You could say, well, we could say very little unless we make very strong assumptions. One assumption that many people often do is to assume that xt itself is linear and Gaussian, right? Then you get the Kalman filter. So, right, if we assume that x follows a linear process with normal shocks and constant volatility, right, then we can solve perfectly for the updating problem, and that's a Kalman filter. If it's not, typically, which is the case, for example, for many of those learning models I showed you in the introduction, where people have written down, maybe a 6-state Markov chain process for the fundamental, then you need to solve things numerically. Okay, it's typically difficult to write results analytically. The key solution we propose in this paper is a theorem that actually characterizes the evolution of every moment of this distribution of beliefs about xt, right? So f of xt given yt is my distribution of beliefs about yt, whose first moment is going to be the price. So in particular, I'm going to characterize formally the cumulants, right? So K1 is going to be the first cumulant, K2 is going to be the second cumulant, and so on. And then we're going to focus on the first three cumulants only, but even though the recursion goes up to infinity, but these three are sufficient to get our results today. And so here is the key result, and this looks complicated, so let me break it down. So dk1 tells me how I update the first moment, which is also the price, right? And dk2 is how I update the variance of this distribution, okay? Which I'm gonna call uncertainty, okay? Which is simply how uncertain I am about the correct value of xt. So how does the updating works? Well, there are two parts of the updating. There's some sort of drift, right? There's if you want, is the diffusion of the information flow, and then there's some updating because of there's something unexpected, right? So there is maybe some mean reversion that happens kind of naturally, even if I don't see any new information. But if I do see new information, well, then I'm gonna change my distribution. So in all of these equations, this is for how the first moment changes and this is how the second moment changes. You see this term over here, which is dy minus the expectation of xt given my prior times dt. What is this? This is the unexpected news, right? I didn't expect to see such a high signal. Well, that tells me something about what must be the fundamental, okay? So this is what I'm gonna call the news. Everything else that you see appears here and it appears here, right? Everything else is something that does not depend on the signal, right? It's just kind of drifting from before. And so what do we see in the first equation? We see, well, when news comes, I'm going to update my mean of the distribution in the following way. I take the news and I multiply by this term, which is what typically called the Kalman gain, which tells me how much do I learn about the first moment by observing the news. And what is that? That depends on the second moment, but how uncertain I am, divided by the variance of the noise. Okay, so the general intuition is, well, if I am very uncertain, so there's a lot to be learned about in some sense from the observation because I just don't know a lot. And I think the signal is, there's not so much noise in the signal. Then I'm gonna update a lot, right? So the update depends on this ratio between K2 and sigma squared Y. One way to interpret this is to say, well, I want to update more if the signal is very informative. So how can I know that? Well, I could basically run a regression. You can see down here, I could run a regression of xt on the signal. And when that slope is very high, it means the signal is very informative, right? And so that's why the Kalman gain, which is this part is also in the Kalman filter, this first equation, is how I update on news depends on this ratio between the uncertainty I have and the variance of the noise. Okay.
So let me jump
Yeah.
in with a pair of questions here. First question, how do you initialize the Kalman filter, specifically the covariance? There is no reason to believe that the error covariance is initialized at the steady state, right?
So here so first of all, we're not doing the Kalman filter. We're not initializing anything in the sense that you can think of this as simply one version of Bayes' updating rule. So we take the prior one day, and we're not going to put any restriction on how the agent has formed that prior. It could be in steady state. It could be during a very high learning period. It does not matter. So the investor has some prior, and they apply Bayes' rule. And you can think of this as simply one particular description or application of Bayes' rule. So we see the prior, we have the updating, we have the posterior. Well, we're not going to have to say anything about what the prior was. We're just going to say, this was the prior, this is the news, this is how it's linked to a posterior, right? In the same way that you can write Bayes' rule by writing the prior and the posterior and the updating part. Okay, so we're not gonna be any more specific than this. We just need this this relation between the news, the prior and the posterior. And there was another
Okay,
question, but
another question. Yeah, the second question. Can I know if the second cumulant is uncertainty or risk? Are they supposed to be different in this context?
Okay, so that's kind of links a little bit to the setup. So here, the way we think about this is that this is so maybe we can just link it, go back to here. Okay, this is the setup. Okay, so in this setup, I have something called the fundamental value, which is determined entirely from what I know about the future and by the STF, right? So risk is embedded in this formulation, right? This is a fundamental value accounting for the risk and how I perceive risk. And we're gonna assume that the STF is exogenous to the news process, to the learning process. Okay. So I'm trying to learn about essentially the present discounted value accounting for risk. And so this uncertainty is not risk, it's just purely really uncertainty about the fundamental value. The two are kind of disconnected because risk is entirely handled by the M, which is what I'm trying to learn about. And this uncertainty is something kind of exogenous. Okay. Now, in the paper, we do think about models where the M itself contains the news, and there's a fixed point there, which is kind of difficult to solve. You can solve it numerical, you can do an approximation, but I don't want to kind of go too much into that. But for the results today, think of risk is being accounted for by what I'm trying to learn about, is all inside the XT, and this is just purely uncertain about XT.
All right.
Okay.
Thank you.
Thank you. So this is first equation. First equation is the same as the Kalman filter. But of course, what's interesting about this setup is because the fundamental XT does not follow a linear Gaussian process, then all the cumulants are moving over time. And so volatility is also changing over time as I see news. And the second equation tells me how that moves. And what's beautiful about this result is that you can see that how uncertainty changes also depends on the news. And again, there's a particular gain, which is now depends on K3 over sigma square Y, right? So it tells you that how I update my uncertainty depends on the news, and it's mediated entirely only by K3. It's only my third moment, my skewness of my beliefs, that determine how volatility responds to shocks. Okay, so that's going to be very, very closely related to the leverage effect, which I'm going to immediately. Okay, so most of the paper will focus on these two equations. Then I'm going to give you some empirical predictions. Okay, so first of all, let me go back 1 second. So you can see that these are the two key equations. They're going to be the fact that the first moment updates when news comes proportional to the second moment, and the second moment updates proportional to the third moment. Okay, these are all the restrictions. There will be one more restriction, which is this term over here, which is in a sense which tells me basically the mean reversion component of volatility, of uncertainty. And I'm going to tell you exactly what these terms here implies. Okay, I'm gonna show you in a little bit. Okay. What are the predictions of this model to how prices should behave? Okay, so first of all, remember, prices are just the change in the first cumulant. Okay, so this already tells us that because the signal is a Brownian motion, right, or is driven by a Brownian motion, then the prices here are never gonna jump. Okay, fundamentals can do anything, right? Fundamentals can jump, but in this model, price will never jump. There will be a diffusion. Okay, they could move very, very fast, right? They could have very fast collapses driven by the leverage effect, but they can never do a literal jump. Okay, it's going to be a diffusion. Second, the volatility of prices, which is the volatility of how this first moment is moving around, will depend on K2, on the uncertainty, and on the information on the signal. Okay? These, in a sense, are the kind of easiest predictions from the model. The most interesting one is this one. Okay? You can derive, by rearranging those formulas, you can derive how the volatility will change, will evolve over time as a function of the price, which is what we do empirically when we compute the leverage effect, right? We're under regression of the change in volatility on the change in the price. And it tells us that this is the slope. Okay, this is the key result. I would say the most interesting result of the paper is this one, that says that when I go and measure this leverage effect in the data, which are those slopes I showed you before, within this model, I'm picking up this combination. I'm picking up K3 over sigma square YK2. And the most interesting thing here is that these denominator terms are both positive. So if I find a negative leverage effect, it has to go through the third moment. So this result kind of gives a tight link between how skewed my beliefs are and the leverage effect in the data. And it says in particular that even only if my beliefs are left skewed, so I think basically the crashes are possible in fundamentals. I believe there's some left tail in the fundamentals. Then I'm going to get a leverage effect. But why does that happen? Well, the intuition is actually very simple. You can see it in a picture. Suppose I'm around here, this left blue line, okay? And this is my distribution of beliefs, okay? And let's say that this is my mean today, so this is the price today. Um, and I get bad news. Well, if my fundamental distribution is left skewed, it means that when I get bad news, I move to this kind of much wider area of distribution. So now the beliefs become much more uncertain, and therefore prices become more volatile. So very naturally, after a bad shock, prices become more volatile. And vice versa, if I'm down here and I get good news, I'm gonna go move towards a narrower part of the distribution. You see the asymmetry here, right? The asymmetry is precisely captured by K3, which tells me that it makes a very big difference if I have a bad shock versus a good shock. Okay? And so in particular, this is the source of why in a very general class of learning models, you're gonna get that negative shock gives me to increase in volatility and positive shock gives me to a decrease in volatility. Okay, so this is the key result.
Before. Oh, well, you might be about to answer the question, but since I interrupted you, I'll ask it.
Yeah.
Does the model imply that the leverage effect is mainly a short horizon phenomenon and that it decays differently after positive versus negative returns?
Okay, so I will answer some of that in the sense that, so within this model, it's pretty easy to characterize analytically right? Think about this. This is a model about the one period update, right? Which is the kind of instantaneous update as news comes. Now, when you think about characterizing the kind of cumulative dynamics, it becomes harder. So I can tell you something about the dynamics. Some other things about the dynamics, I can give you a local approximation, and then numerically I can tell you what happens over longer horizons. So it's kind of difficult to characterize analytically how every moment will move over long horizons because it's very, very nonlinear, this entire dynamics. So if xt is nonlinear, all of these dynamics are very nonlinear. So we can think of it as we're characterizing the instantaneous update as news comes. I'm going to be able to tell you something about the decay of uncertainty. For other kind of long-term dynamics of other moments, they're going to depend on the fundamental process. I cannot characterize them all analytically. Okay, but I'll tell you what I can characterize.
Okay, there are two follow-up questions too. That's interesting, but that also seems to imply that if my prior is right skewed, I would get the opposite leverage effect.
Great question. In fact, we're going to test it in the data. So hold on, because if I have time, I hope to have time to show you that. Yes, exactly true.
And then the other related question: does the model also imply something similar to a leverage effect, but between the second and third moments instead of the first and second?
Okay, so yes, in the sense that basically one way to think about this, I'm going to just go back to this equation. So the way essentially, you can think of it as there's some fundamental news that we don't observe, right? But we observe how the price change, we observe how the volatility change, and the leverage effect is just telling me how on average these two things are moving together, right? There's absolutely going to be something like that for the second or third moment. That will depend on the relation between the third and the fourth cumulant and so on. So there absolutely will be something like that. But the problem is that so the reason why we stop at these moments is, first of all, there's quite a bit to learn from these moments, and also that as you go to higher moments, it becomes harder to measure them in the data, right? So we have not done that much to higher than third moment. We've done something with the fourth moment, but here today we'll only focus on the first and second moments dynamics. Okay, so the next slide tells a little about the decay, which is, think of trying to characterize the the mean reversion of volatility is entirely driven by this red term. So in continuous time, if you have the standard exponential decay, you will not have this square here. There will be standard OU process. What does this square mean? This square means there's something kind of very natural once you think about that, very general to learn, which is that when volatility goes up, or when you get a bad shock and volatility increases, how it's going to change over time? Well, it changes in the following way. Because volatility is very large, signals at that point are going to be moving my price a lot. So I'm going to be learning a lot endogenously. But then as I learn more and more, volatility is going to reduce. So of course it's going to mean revert, but it's also slowing down learning. And so that's why volatility is gonna decay more slowly than exponential, because I'm gonna learn a lot at the beginning, so I'm gonna have a very fast decay, and then the decay of volatility itself will slow down as I learn less and less because my uncertainty goes down, so the signal itself is gonna be less informative. So this mechanism is precisely how this learning model, every learning model really essentially, will be able to generate uh, um, uh, slow learning and non-exponential, less than exponential decay in volatility dynamics. Okay, so that's the long memory. That's where the world was leading. Okay, so now I have only a few minutes left, and so I want to show you two things. One is I want to show you that given all this, right? Given the fact we're saying, well, it's basically what we're saying is that any model with skewed fundamentals, so where my beliefs are going to be skewed, should generate the leverage effect, and any model we learn should generate this should generate long memory. Uh, we should be able to write down a model, a pretty simple model that matches these patterns qualitatively. In fact, it turns out that we can actually write a very simple model that matches this pattern quantitatively. Okay, so that's the goal of this. That this lesson tells us we can do it qualitatively. It's actually not that difficult to do it quantitatively. How do we do it? We essentially take a standard ray disaster model. Okay, so in particular, we're going to calibrate to the parameters in Barrow and Gene, but it's kind of that family of Barrett-style models where you have a fundamental that, once in a while jumps. So JT is going to drive the jumps, and there's going to be some probability of disaster and some size of disaster, right? So we have very few parameters. And the only thing and we're going to calibrate these parameters to Barrow and Gene. And then the only thing that really the 1 degree of freedom we have in this simple model is going to be how much noise there is, right, in the learning. So think of it as Barrow and Gene, the standard Barrow model, with added learning on top of it. And it's very important to realize in Barrow's model, the jumps are, so there's no stochastic volatility. The jumps are going to be completely IID. And so any kind of leverage effect is going to be driven entirely by the learning. Okay. So what do? We take the model, we simulate it. Okay, we're going to calibrate this one parameter to try to match the data as best as we can. So we have 1 degree of freedom. And what do? We simulate 100 years sample. Okay, so here you can see the blue is the fundamentals and red are prices. Okay, and what you see is of course there's the price does track the fundamental, but there are interesting cases. There are some cases where there is a jump and the price takes a little bit to adjust to it because people have not noticed the jump yet, right? They're learning that there was a jump and they're learning about it. And there's also cases you can see here where, in fact, there hasn't been a jump, but prices collapse because people thought there was a jump, right? And you can see this asymmetry because here the jumps are always to the left, right? There's always downward jumps only, and therefore, when the system is the dynamics are going to be very nonlinear and very skewed to the left. Okay, so there are jumps. Sometimes they're due to fundamentals. Sometimes they're going to be due to noise, but the prices themselves are going to be diffusion. Okay, so there's never going to be a jump in the price. There could be very, very fast collapses. So you can see if you look at year 8, which is around here, you see there was a big jump in fundamental. So let me zoom in into what happened then. Okay, so the gray line here is the fundamental. You can see that the blue line is the price. The price, is catching up to where the fundamental is, never quite been exactly equal to it. After the jump, the price very quickly collapses and then takes quite a long time to recover. Okay, and why does it take a long time to recover? Again, it's because of the dynamics of volatility. Volatility is the red line. Because of the leverage effect, volatility spikes very quickly after the collapse, and then it reverts relatively quickly. And so by the time the volatility comes back down, then the learning slows down, and that's why prices take a while to recover. And so, and this is it's a impulse response function from the model that tells what happens after these two types of shocks. So one shock is, so in this slide, we're gonna have just pure noise. So a noise event like this one, basically. What happens in those events? On average, it happens that the price kind of goes down very quickly. In fact, it kind of accelerates down because as the price goes down, uncertainty increases, so I update even more, and therefore the next price movement is even bigger. So you see this very, very fast acceleration of prices. And then through the mechanism that I showed you before, volatility goes up and then slows down, which kind of slows down the recovery of prices. Okay. So what this is telling us, it's very plausible in these kind of models to have events where actually fundamentally nothing happens in the fundamentals, but you get the best string of signals, and that could drive the price to drop very quickly and recover very slowly. Okay, and this is kind of feature that it seems like we can see in the data. Sometimes we see events that move the prices a lot, and the recovery is low, but it's not very clear what actually was the fundamental event driving it. Whereas in other cases, there is a fundamental drop, and now learning could be very slow. And in fact, prices could take a very long time, including in these calibrations, up to 5 years to adjust. This is a large negative jump. Why? Because even though there's a jump, there's also a lot of uncertainty for people. People are still trying to learn, and it takes them a while. And and again, the slow learning is driven by the fact that volatility, yes, initially spikes, but then kind of drops, and that's kind of slows down the learning. Okay, so you can see that there are actually this very simple model can generate a lot of pretty realistic dynamics of prices and jointly volatility.
Okay, so let me jump in with another question here. Can you differentiate between a rational learning story versus a behavioral story?
Great question.
Yeah, okay.
Great question. So it turns out that what you see here is essentially saying, well, this model is saying that there's a Bayesian updating happening. It's based on essentially people having Bayesian updating. But there's a lot of like non-rational things that are still allowed by our model. For example, people who have wrong prior, they could not use fully the information that they have. So the only really key that needs to be updated, they could be also even updating, there's some variation of Bayesian updating that like the Generaioli kind of biases in updating that are also consistent with this. So the only real restriction here is there's this kind of updating is going on. Okay, there's a lot of behavioral, not every single behavioral model, but there are a lot of behavioral variations that could be allowed in our framework. For example, you could mistakenly ignore some information that's completely allowed here.
Okay, and then let me make one administrative comment. It would be great if you could finish in between 10 and 15
Yeah,
minutes.
that's in the
Okay.
past. Thank you. Yeah, thanks a lot. Okay, so let's go and check how this model does with data. Okay, so remember these graphs I showed you before? This was the leverage effect unconditionally through all the months since 1990. You can see the blue line is the data, the red line is the simulated data. You see we match pretty well the distribution. On the right side, we have the distribution of volatility in the model. Blue is the data and red is the model. So, it doesn't fit perfectly. There's a fatter kind of tail in the data. There's a fatter left tail in the data, but we match qualitatively pretty well and even quantitatively pretty well. The distribution. Remember these pictures about the skewness of returns over horizons that I was telling you? Well, short-term returns are not left skewed because really there's most of the skewness does not actually come from jumps. It comes from the leverage effect. And if you hold for a longer period, you have kind of more chance for the leverage effect to play out into worse and worse tails. Well, you see that in the data, right? With the skewness, it becomes more negative as the horizon increases. And you also see that in the model. It generates exactly the same pattern quantitatively. And we also match very well the non-exponential shape of the the persistence of volatility. Okay, so we match the data on a variety of fronts quantitatively. I'm going to skip this table. And I'm going to go to one last empirical test, which I think is very interesting, which is because, let me go back 1 second to show you where this is coming from. In this equation tells us very clearly when you see news, the first moment should move this way, the second moment should move this way, the third moment should do this way. So there's a lot of cross-equation restriction in I have one piece of news and all the different moments have to move in a particular way. So the prices should move in this way, the volatility should move in this way, the third moment should move in this way. So we can essentially write down this as a test, okay, of all these joint restrictions of the model, how every moment of prices should move as you get information. So we can write these tests as a regression. In particular, we can regress volatility on these two things. One is the skewness of prices times the change in the price. That's kind of how the first moment moves. And the second is the decay of volatility. Okay? So what this is saying is that if I were to run a regression on the change in volatility daily on this particular scale function of returns and log square volatility, I should find coefficients of 1. And the second coefficient should actually estimate essentially this famous sigma y. Okay? And so this is interesting because on the one hand, it allows us to actually test the model, right? First of all, this has to be a positive number. and this has to be 1. And second, it allows to give us a back-of-the-envelope calculation of what this noise in the signal should be. Okay, so I'm going to show you this regression in 2 markets. Okay, the first one is the S&P, which, as you know, so this is the volatility of the S&P, and this is the implied skewness from SIBO from the options. And then this is natural gas. Now, there was a question at the beginning of, well, would you expect the leverage effect to go the other way when skewness is positive? Well, the answer is yes. And here is a natural gas. This is volatility, and this is its skewness. You see, natural gas contracts turn out to be positively skewed. So what should we expect in this equation if you do it with natural gas? With natural gas, we should expect precisely that because the skew is positive, this essentially is, this one here is capturing the idea that the leverage effect is going in the right direction, right? So if we see a 1 in this equation, it tells that indeed, because the skewness is positive, the leverage effect should work the opposite way. So we should find the 1 if the model is correct, both in markets where the leverage effect is negative and the skewness is negative, and in markets where the leverage effect is positive and the skewness is positive. So we should find 1 every market you look at, no matter whether the skew is positive or negative. Okay? And this is the table of the tests. So I'm gonna just focus on this. Let me start with this first equation, which is kind of really the equation in the model. This coefficient minus 0.74 you see here, that's our estimate of 1 over sigma y. I'm gonna talk about that in a little bit. That second coefficient is the one that should be 1. You can see that is actually 1 in S&P 500 and also in natural gas, which is answering to whoever asked this question before. Indeed, that in the natural gas, it's true that skewness is positive, and indeed we find a leverage effect going the other way. Okay, so that confirms that. And then, these results are pretty robust to controlling for lag volatility and lag change in price, though the results are not, they're not exactly the same. And from this second, and I'm going to try to conclude soon, from these numbers here, from these coefficients of volatility, we can get an estimate for the sigma y, which is somewhere between 1 and 2. Now, we can do a little heroic, a bit more back-of-the-envelope calculation. You can say, well, in the model, the VIX should just be K2 over sigma y. We observe the VIX, we estimate sigma y. We can have an estimate of the uncertainty people have about fundamentals, right? So these results are saying that in terms of order of magnitude, this is saying, if you ask, the average investor about how uncertain they are at this point in time, or on average, about the true value of the stock market, their uncertainty should be in the order of 10% or 16%. Think of the standard deviation of their fundamentals. So, I'm not sure entirely about the true value of the stock market. It could be, let's say if you take 10, 20% below or 20% above what's today, with 95% confidence, 95% confidence. Okay, so that's kind of the idea. So now, how can we validate this in the data? Well, we can't, because we don't have great direct information about how uncertain people are about the stock market. But there was a survey that Schiller is running, where they ask people, what do you think is the fundamental value? And we don't have the uncertain, but we can look at the dispersion across people. And that dispersion across people are on average 17%. Okay, so we're at least in the ballpark of that amount. Okay, so I think the model makes sense when you kind of compare it to data. Of course, these are kind of stylized predictions, but I think it's in the right ballpark. Okay, so as promised, I'm gonna finish on time. So so the point of this paper is to first introduce this new filtering result, which describes the evolution of very generally of beliefs over time. Of course, this is not just a result of prices. It's a very general theorem. We just put on our websites a separate paper that kind of applies these ideas to learning about inflation, for example. And but there is, of course, it's very generic in terms of like the fundamental DGP that people have in mind and their beliefs. It's very restrictive because, of course, it assumes the information is coming with a one Gaussian signal. Okay, so I think it's progress, but it doesn't solve the fully general model. But I think there's a lot of interesting applications, including trying to understand where many of these joint patterns are coming from, like the leverage effect. And we think that it's impressive they can generate so many patterns. Okay, I'm gonna stop there to see if there's more questions. Thank you.
So thanks very much. Now, this for everyone. Now is your time to ask any remaining questions. So at this time, feel free. If you have a question, feel free to unmute yourself and shout it out. While people are thinking about their questions, I'll ask the question that I deferred to the end. And so the question is simulated method of moments still the gold standard in estimation of these models, or would you prefer other methods?
Oh, that's a good question. So um I think I'm totally fine with simulated method of moments. But I think here we're using likelihood methods, but I would say that I think maybe Ian can answer that because he's the one that did the estimation of the model. But I think that simulated models is totally fine.
So we're working on trying to do like the full estimation via likelihood methods right now. Like certainly in the quantitative example that Stefano showed, like in principle, that is, that's a fully specified model and you should be able to estimate it. And so like if this model works, that should work. And then it's just a question of how do you get everything to actually match the data and make sure that everything's sufficiently flexible. I don't I'm always a little skeptical of simulated method of moments just because it's going to be dependent on the choices that you make about the moments to match, right? And so we showed you some of that today, but I think you should be skeptical that we picked the stuff that works and we calibrated it to make sure that it works. So I think we view it as a proof of concept, but actually showing that this thing can fully capture the whole range of what you see in the data is a much harder thing, and that's what I'm currently battling with.
All right, thank you. Any other questions? Feel free to shout them out. No other questions? Last chance to tell Stefano he's wrong.
Well, I definitely won't say that he's wrong because that would be a I don't I'm more curious about your take on what so here there's no risk premium, right? Well, you said that there's kind of an extension or a discussion of what happens in a.
So let me clarify because that's a bit tricky. But so the idea here is the following. We allow for risk premium because we allow for the stochastic sum factor as being part of the fundamental, right? So it could be time varying. It's a very, very general process. The restriction is essentially how people learn, right? Is basically there's a separation between the fundamental I'm trying to learn about, and that includes the risk premium, and this kind of learning kind of layer on top of it. And the two are kind of separate, right? So the idea is one way to think about this is simply that it's an approximation of the fact that I'm an analyst. I try to figure out what is the fundamental value of this company. I have my assumption of discount rate. I apply discount rate, presumably includes the risk premium, and I try, okay, if that's my goal, what do I know about that today? Like, what does everything I observe tell me about that fundamental value? Now, what the one thing that is a bit tricky is, of course, this dy is a news term, is a noise part. It contains noise and signal, right? That stuff itself could enter the SDF, right? So, for example, the SDF could depend on my wealth, and my wealth depends on the price, and the price depends on the signal I observe, and there's kind of this circularity. So the extension that we do in the appendix is basically saying you can think of, instead of thinking of the fixed point, you can think of this iteration where I do it in step. I assume a certain risk premium, I see the noise updates the price, and then the price enters the SDF. I can do it like in steps. You can see how things moving in some, if you want, step by step in this process, right? And so it's not like it's not feasible to solve. In fact, for example, if you look at Veronese's paper, right, he essentially solved this fixed point numerically. I think that I think the fundamental question is there something going on? Can something be going on in that fixed point that will break some of these results? Like, will you stop having the leverage effect through this? I think that's the question, but we cannot answer the question without solving the model. So I would see this as an approximation to the learning process. It doesn't encompass every learning model, strictly speaking, but it gives an approximation to what can learning do to prices, basically. What does this learning layer adds to the dynamics of prices?
I definitely wouldn't imagine that it would kind of break the leverage effect, but I was kind of curious if you had a take on how, this would speak to kind of the skewness premium in a sense, because here you're using the fact that skewness kind of is increasingly negative as the horizon increases, but in options we observe that the smile flattens with the horizon. So there has to be something in the skewness
Yeah,
response.
so those things about the horizon are very interesting. They're very difficult to speak to analytically because of what I said before. These results are instantaneous, but the compounding requires you to know the entire process. So we can do in the calibration. How do those effects change if you have the risk premium being endogenous to information? It's a very good question that I don't know the answer to. But I think for that, I mean, we have not found a way to do it without actually solving the model. Yeah.
Well, thank you for your take on this. Did this give anyone ideas for new questions, or are we good to wrap up? Seems like it's time to thank you, Stefano.
Thank you. Thank you very much. It was
Great
great.
having you. Everyone, thank you for being here. I guess if you were here, it's because you got Dima's email saying that Stefano was the first of a series of illustrious speakers. So we're very much looking forward to seeing